All right, let's dive right into this explainer. We're unpacking the latest updates from IRS Tax Brief Issue 12, and we're going to do it fast. Whether you're a seasoned CPA or just an everyday taxpayer trying to keep your records straight, there are some major mid-year shifts here that you absolutely need to know about. Let's be real for a second. Tax rules change constantly. Sometimes the limits shift right in the middle of the year, and you're just left scrambling to catch up. And hey, sometimes even the most qualified tax professionals make an honest mistake on your filings. So what happens then? Well, the IRS actually just dropped some new guidance covering both of those exact scenarios.
Section 1. Changes to your wallet, specifically rates and gift tax limits.
So the big takeaway here is a sudden mid-year bump to the optional standard mileage rates. Effective July 1st, 2026, the rate jumps up to 76 cents a mile for business use. On the flip side, if you're driving for medical or moving purposes, that rate is now 23.5 cents per mile. If you, or maybe your clients, track mileage for deductions, you've got to make sure those logs are updated for the second half of the year. It adds up fast. Moving on, the IRS also just rolled out a new safe harbor rule. Basically, this allows certain contributions made to Trump accounts to be officially treated as completed gifts. And here is exactly why that matters. If you meet specific conditions, those contributions qualify for the 2026 annual per-donee gift tax exclusion of $19,000. The best part of this? You can do it without even needing to file a separate gift tax return. It literally just simplifies the whole reporting process while keeping you safely within the annual exclusion limits.
All right, moving into Section 2, grace for professional errors and late election relief.
Now, for some really good news, the IRS has thrown taxpayers a lifeline in two recent rulings, and it's all based on one core idea, and that is reasonable cause. Basically, the IRS has decided that if you reasonably relied on a qualified tax professional and they made an error, that actually counts as reasonable cause for getting an extension. So if your CPA messed up a super technical filing, you might not be completely out of luck. Now, I don't want to get bogged down in heavy tax jargon here, but just know this relief applies to two pretty complex areas. First, late Section 336E elections for S-Corp stock dispositions. And second, missed generation skipping transfer or GST exemptions. What's actually super fascinating about this is how they apply the fix. Let's say you missed that GST allocation because of your tax pro, and the IRS grants you this extension. The fix is totally retroactive. The allocations become effective as of your original transfer dates based on the fair market value from that exact time in the past. To patch things up, you just need to report it on an amended Form 709. Pretty neat, right? So as we wrap up this quick explainer, I want to leave you with this thought. How much money could a single honest mistake be costing you right this second? Take a few minutes to review your recent returns. Maybe reach out to your tax professional and ask if you need to leverage these new grace periods or those updated mid-year mileage limits. Don't leave your hard-earned money on the table. Stay proactive, and I'll catch you in the next explainer.